Hello, everyone. This podcast is one of our pearls of wisdom, imparting our knowledge and experience to tech entrepreneurs. Today, our founder and chairman, John O'Connell, is listing the most common mistakes made by entrepreneurs raising Series A funding from 3 to 10 million. Welcome, John.
Thanks, Andrea.
So, John, your experience is both as an entrepreneur, you founded Staffware PLC, listed it on the London Stock Exchange, then grew it from 4 to 50 million revenue before it was acquired by a NASDAQ listed business by a handsome premium. Now you've gone to the dark side, as you jokingly describe it, for the last 10 years with ScaleUp Group, which has obtained circa $100 million of growth funding, including you and your colleagues personally investing circa $7 million. So, John, this is a unique business model, I believe. Where did you come up with it from?
Well, Andrea, I've been a chairman for 15 plus tech businesses since Starfare PLC, and it just seems so natural that all board members should have some skin in the game to ensure they were aligned with the entrepreneurial founders. So this alignment philosophy I carried over to ScaleUp Group to distinguish us from being merely a broker. Another upside is that I and my 34 colleagues, all tech leaders, are available as a virtual advisory board to our clients. This is an incredible source of knowledge, experience, and connections. For instance, we've placed more than 20 C-level executives for our clients from our network, cutting down considerably both the cost and the risk associated with hiring strangers. More prosaically, we invariably invest more than the fees we charge for obtaining the Series A funding, meaning our clients are getting the best advice, and it's also a cash positive experience for them.
It's so impressive, John. But being an investor, albeit for no more than 5 to 10% of the raise, to show your belief in the client, does this mean that you are as selective as the funds are? I understand that the fallout rate for Series A level is extremely high.
Yes, Andrea. The dirty secret is that the objective of funds on the first encounter is to eliminate the vast majority from further consideration. They'll see around 1,000 pitches a year, 20 or so a week. They invest in only 1 to 3 a year. So the odds are stacked against the entrepreneur.
Mm.
But our difference at ScaleUp Group is that when we see entrepreneurs with great potential, but knowing from our experience as presented by them, they would not get the funding they're looking for, we coach them to ensure they do. We are the coach, ensuring our clients are match fit before getting on the pitch, literally.
Excellent. So silly question, but why should tech entrepreneurs then bother fundraising at all?
Andrew, that's not such a silly question. We all kind of go along with it. But simply put, bootstrapping a business with high growth potential by relying upon cash from your customers, the old-fashioned way, you might say, just takes too long now. This is even more so the case with no business in tech can have several years to evolve successfully anymore. So external funding comes in to plug the cash gap, avoiding an entrepreneur waiting for the cash to come in from their customers. With funding, this means that the entrepreneur can invest, usually in hiring people, much sooner they otherwise could afford to. As big tech gets ever more dominant, especially with AI now, this window of opportunity is getting shorter and shorter for a small to medium-sized business to establish itself as a significant player in its chosen market.
That makes sense, John. So now, are you going to tell us some of the common mistakes to be avoided so that the entrepreneurs listening can crack on with their expansion plans?
Yes, Andy, I am. I hope it does not put people off going for growth funding, though. Um, and do bear in mind, no two situations are absolutely identical. Also, that I'm primarily talking about a B2B SaaS business with growing recurring revenue, ARR, as it's referred to. Firstly, starting with what most funds see at the beginning, the investment presentation itself. This is the only opportunity to make a good first impression. The adage, fail to prepare, prepare to fail, applies here. It's not a sales pitch to a prospective customer for a product or a service. The goal is to make funds believe that this is going to be an excellent return, so that they will want to find out more. And most importantly, this opportunity compares favorably with many others they might be considering. The presentation itself should address the key levers funds know underpin successful investments in no more than 15 slides and no longer than 30 minutes. The funding decision by a fund is a mixture of science and art. The goal is to get all the science boxes ticked, then the art bit, having persuaded them of the opportunity that the entrepreneur and the team can execute on it. A big question itself.
That's not much time, John.
Unfortunately not, Andrea. Funds like entrepreneurs are time challenged too. Here are the calculations funds have to make once they are convinced there is a large enough market in the first place. So say a fund has 20% of your business for, say, a £5 million investment. This implies, say, 4 million of annual recurring revenue at a 5x multiple pre-money. So the post-money of £5 million is a 25 million valuation. In other words, 5 times 4 is 20, plus the 5 of new money coming in, 25 million. So for funds, the question is, can the whole business be worth 75 to 125 million when it is acquired? Because they're looking for a 3 to 5 times return on their money. So that means that if the exit valuation, i.e. when the company sells, is, let's say, 7 times their ARR, the ARR needs to be around 11 to 18 million pounds, depending upon what that exit level is. So we're implying a growth rate of 25 to 50% every year. I hope these numbers are clear when people think about them. So holding out for a high valuation, which is, of course, the natural instinct for most entrepreneurs, will mean that fund will need to be even more convinced that the business can be sold for more than is otherwise the case, which in turn means, can they be convinced that you, the entrepreneur, and your team can grow the business even faster than the figures I've just quoted? So it becomes a little bit of a catch-22 in a way. The higher the valuation, the more demanding the growth rate will be. So something for all entrepreneurs to think about when a fund is looking at the proposition and their growth rates and the size of their market. Next comes the supporting evidence. So all of what I've just said might seem awfully academic, but funds are really impressed by not just potential, which is, of course, what entrepreneurs want to talk about, but as importantly, what has already been achieved, what growth has been achieved to date. And they look at the projections for the future. Are they credible? Does the go-to-market strategy justify such an ambition? In other words, do you have firm stats on how many leads you need to generate to be converted into prospects? And what is your conversion rate from prospects to deals? How sustainable are the customer contracts? In other words, the retention rates. For how long does a customer stay a customer? And do they spend more each year? We all know that it's much easier in terms of effort to get existing customers to spend more money with you than it typically is to get brand new customers. So spending more money, which is what's called the net retention rates from existing customers, is a key sign that there's increasing value being delivered by you, the entrepreneur. The shorter the history of the business, the more likely it will be that a fund's expectations will be higher than the 3 to 5x return, by the way. In other words, if you only got a year or two's track record, then they'll see the risk is higher, and therefore they will expect a bigger return to compensate for the higher risk. Another key evidence point is of product market fit. Less than £1 million suggests that there aren't yet enough proven customers, as is excessive client concentration. In other words, if you've got a client which accounts for 30, 40, or 50% of your total revenues, what happens if that client were to leave? And also, does a single client represent your main market, or are they just a one-off early adopter? So a number of issues there, Andrea.
Quite a few points already, John.
Yeah, and unfortunately more to come. But this is not a game. Even though I talk about coaching, this is really a pivotal moment in the life of an entrepreneur and his business. So a slightly easier one to establish is upfront is what's called the hold period. You don't want to be talking to a fund which has a expectation of a return in, let's say, 2 to 4 years. If your projections imply that it's going to be a longer period than that. Likewise, if a fund is an evergreen one and doesn't have any pressure at all to exit, then will they be happy if you and your colleagues wish to exit within, say, 3 years? Another factor in all this is if we're talking about venture capital trusts, which are these tax advantage funds, very generous schemes the UK government has had in place for any number of years now. Do you and your colleagues want to take some money off the table now, what's called secondary, as well as putting more money into the business? If that is the case, unfortunately, under the rules, a VCT, which are the main source of Series A funding, cannot accommodate you. So it's important to know both the length of time a fund expects to hold your investment, and that's properly aligned, and also whether or not they've got the flexibility to give you any liquidity before a final exit. Andrea, next is probably the most common mistake made by tech entrepreneurs, which is simply not explaining what is the problem being solved. Too many entrepreneurs get carried away with the what they do before funds have understood why they're doing it and why now. The presentation should not start with how wonderful the solution is, nor how clever the AI is. Funds want to know, why is this solution being bought? And why now? Is there a burning platform motivating potential customers to spend money now, such as legislation, different trends in the market, etc., etc.? And are your current customers, as I mentioned already, representative of the reasons why enterprises will be buying now? Small, medium enterprise businesses and to very large ones is a very demanding process, with long sales cycles. So it's really important that there are real motivations as far as enterprises are concerned, rather than your offer being one of their nice to haves, which very rarely come to the top of their list when it comes to buying.
Yes, John, I must admit that sometimes I have no idea why and who needs some of the technology being described.
Yeah, I entirely agree, Andrew. Just imagine you're a fund hearing 1,000 pitches a year. Yeah. So next one is one of my pet hates, a ridiculous size market claimed. This is one of the most irritating ones, when invariably an entrepreneur describes the market size in the multi-billions of dollars, and then they claim they are or will be a leading player, yet with a tiny fraction of such a figure. It just makes no sense and lacks credibility. This tells a fund the entrepreneur has not differentiated an enormous market into bite-sized segments so that they can identify a sufficient number of ideal customer profiles, ICP ones. So the goal is to convince funds your market is large enough in which, say, your 10 or 20% market share, being realistic, justifies the projections you're showing a fund. Presenting this in a way where the fund itself can model variations in assumptions, such as number of customers won, their average spend, etc., enhances their understanding no end, and also convinces them that you are focused rather than having a scattergun approach. Andrea, another mistake is stating there's no competition. This is a serious red flag for a fund. I know to my cost in my very early days. I thought I was so clever having a unique proposition, but it's telling a fund that the entrepreneur is pioneering, creating a new market, which is a long and expensive process normally. I can certainly testify to that in Staffware. And as bad, does not really know their market well enough to find out who the competition is. So relating this is the existence or not of what we call a moat surrounding your castle. Are there already major defensive obstacles you created against competition? If not, the investment proposition can look weak or unsustainable over time. Moats can be established because of the technology you have, your first mover momentum in the market expertise and knowledge and connections, relationship with distribution channels, so on and so on. A key aspect is to convince a fund such differentiators are sustainable. Simply selling on price alone is invariably not, as larger competitors come in and trash the price if they're so minded. Next comes convincing technology. Andrea, this may be surprising to some that we have not discussed this already, and it's surprising that in the US it has a greater emphasis than here in the UK, but normally. But the point really is that technology's developments are now coming along so fast and furious. AI, of course, accelerating the adoption of technology in many, many industries, and also challenging the whole development cycle, which means that technology differentiators are now unlikely to last for the length of the investment journey, which let's say is 3 to 5 years as far as entrepreneurs are concerned, especially as the entrepreneur's pioneering success can motivate competition, some very large, to enter your market too. Of course, you need to convince the fund that you do have a very strong technology base from which to build. And the second point, however, is to assure funds that you're not raising cash to fund product development as a technology debt, in other words, a catch-up, that you've promised clients all manner of new features and functions which you don't yet have, which will be regarded as A, unprofessional, and B, you really catching up before you moving further ahead in the market. So obviously, for a technology company, continual ongoing investment is the norm, but it's important not to make it sound like it is the primary rationale for the fundraise. Andrea, I'm going to keep going for a bit longer here. Next one is management and its experience. Success doesn't happen on its own. It has to be led. And do you and your leadership team have the necessary credentials to achieve such the growth which is being articulated? By all means, explain how the organization structure will be developed post-funding, including if there are additional leaders in your sites, but only as supplementing the existing team, not because of serious weaknesses you have there already. Allied to this are forecasts, flaky forecasts, the thoroughness of the model, the supporting assumptions and the rate of growth, past and future, are indicators to funds of the entrepreneurial's professionalism. Their deep understanding of the operational drivers and your level of ambition. Many entrepreneurs think these forecasts are somewhat theoretical, and how can they possibly be held to them, which they can't be. Fund will expect them to be done carefully and with the best knowledge possible, but clearly they can't ask for guarantees at all. But it does indicate and reveal how well the entrepreneur knows their business, and also how ambitious they really are. If they're only planning to hit, say, 5 million revenues at, say, 15 to 20% growth per annum, that's unlikely to attract many growth-oriented funds. On the other hand, 100% compound for any number of years, there may well be questions asked about the credibility of that too. A robust model with a minimum of hard-coded data provides confidence to a fund that your ask in terms of the funding amount is soundly based. Don't forget having some contingency in the event of growth not being achieved, as stated. It does happen. A black swan moment, COVID and other factors like this, I've never ever allowed for in a forecast, and I don't expect that they ever will be, by the way. But also, more simply, don't forget to allow for the cost of the fundraise itself too in all this. It may not be a bigger single factor, but it does indicate you're thinking it through carefully, and you're not sloppy in your forecasting and management of cash. Providing your model to funds will trigger many follow-on queries from funds. A well-stocked data room is vital. Slow, incomplete responses kills the interest of funds very quickly. Be warned. The model should show how you intend to spend the investment and when. Years 1 and 2 are the main investment years. By year 3, sufficient momentum should have been achieved for the cash outlay to be reducing drastically. And preferably, there's a small EBITDA at the end of year 3. And year 4 should be an indicator of the profitability rate of the business going forward. Andrea, we're on the last lap. You'll be pleased to know. Skeletons. All businesses with any history have some legacy issues, some small, some not so small. The extent of any real showstoppers can make or break the fundraising process. How an entrepreneur reveals them and its timing of when they do is a key factor in establishing trust, which is a vital ingredient in the decision-making process of a fund. Remember, 1 minute they're perfect strangers, next minute you're going to be sharing a board table with them for the next 3 to 5 years. Another factor, which may not be quite a skeleton, but because it'll become obvious very fast, is that if excessive capital has been raised historically, by excessive, I mean you've put in way, way more than you are currently achieving in terms of revenues, then this does raise concerns with funds that you might be a high spending, possibly financially undisciplined organization, and that this behavior may continue in the future. So if you have raised a lot of cash in the past and maybe it hasn't worked out, you've had to change tack, which can be described as being a good thing of resilience and flexibility. But on the other hand, do assure funds that you are disciplined and financially mature. Otherwise, there'll be difficulties with them.
Well, John, that's quite a catalogue of pitfalls, isn't it?
Yes, I'm afraid so, Andrew. Which unfortunately explains why the failure rate is 99%. So let me just try and summarize very briefly. The key points entrepreneurs should address are: number one, understanding the dynamics of how funds calculate what is a worthwhile investment. What multiple will a fund want? What risk will they not like, etc., etc. And number two, being well prepared to address all of the key points funds are interested in, such as what we've listed today. What is the problem being solved by your technology? not just simply how smart your technology is. Why will customers pay for it? And why now? Your track record to sustain and justify your ambitions for the future. What market are you in? Is it one which is realistically obtainable, and can you get a reasonable market share? And therefore, what is your competitive, sustainable advantage? And then finally, the quality and experience and pedigree of your team are all major factors. Backing all this up with as much evidence as you can provide, more independent data, the better, will give funds a belief and feeling that this is a professional organization with whom they would wish to do business. And they're more likely, therefore, to table a funding offer. Andrea, needless to say, we at ScaleUp Group have a 100% success rate in obtaining offers for our clients, despite all those pitfalls you've referred to. And we do this after thoroughly surveying the market in order to ensure they have the best possible offers, including terms, just as important as valuation from a fund, which will be a value-added partner on their journey also.
Excellent. Well, John, many thanks for sharing your pearls of wisdom on this mistakes to avoid when entrepreneurs are looking for Series A funding. And I think if I can add, John, I think you're too modest to admit here, but probably the biggest mistake is not to retain ScaleUp Group to be your advisor, not forgetting that we will also be showing our support by contributing to the round as well.
Thank you, Andrea.
Mhm. Thanks, John.